Over the weekend, the USA carried out a military operation to arrest Venezuelan President Nicolas Maduro. Now, Venezuela sits on roughly 300 billion barrels of proven reserves, most of it heavy crude in the Orinoco Belt, that's been largely offline for years because of sanctions, mismanagement and lack of investment. Well, today we're going to look at what the USA's intervention in Venezuela could mean for oil supply demand, pricing and Western energy security. And joining us to discuss this further is Wasif Latif, the co-founder, president and chief investment officer at Sarmaya Partners. Wasif, thank you for your time. How are you?
Good, Mark. Thanks for having me. Appreciate it.
Well, it's really good to have you on. Thank you very much for your time. Of course, when we last spoke, which was back in Zurich, we did discuss your bullish outlook on the return to tangibles theory. And I remember you were very bullish energy and oil. So has your view altered in any way given the Venezuelan situation over the weekend?
Not on a long-term basis. So we are secular investors, and our secular view on energy remains the same. We're very bullish on the space, particularly in the equities of energy, which is where we invest in, not directly in the commodities, because the commodities can be pretty volatile on a short-term basis. So our interest is in the equity space, and we're very bullish on that sector because of what we see on a longer-term secular basis between supply and demand, investments, and then the ultimate growth of the need for the demand over time in the developing countries.
So you're not concerned about perhaps an influx of supply coming to the market when US oil companies move into Venezuela, for example?
Well, the promise of the supply is fantastic, as we all know now, that Venezuela is sitting on the largest proven reserves of oil in the world, and that's been the case for a very, very long time. There's a long history between the U.S. and Venezuela, particularly when it comes to oil. So going all the way back to the 50s, 60s, up until the mid 70s, when socialism kicked out those companies because they effectively they nationalized the companies, and they effectively put the taxes on the companies at about 100%. Prior to that, what is now currently Exxon was deeply involved, and what is now Shell was deeply involved in Venezuela. So they've been there for a long time, and the proven reserves are definitely there. What hasn't occurred over the last several decades since the 70s is the production, because the production continues to decline and is very, very little at a trickle now. And that is because of the continuous need for infrastructure and investment in this space. So all of that is to say, yes, there's a lot of proven reserves, but for those reserves to translate into direct supply into the market, that's going to be a long, long journey. Okay. And moreover, it's going to require a long line of investments that are going to come into it. The last piece that needs to be considered is a lot of the companies, especially in the West, in the US particularly, have been chastened by the boom that we had in the shale boom here in the teens, and the challenges and the problems that they faced when it came to being good stewards of capital. In our view, that those days are past, and now those companies are much more capital conscious. They're much more interested in return on capital. That's a stated goal from the majors. For example, Exxon and Chevron have both stated very, very specific targets of return on capital. Mm-hmm. And that means that investment required will need to be reviewed to make sure that they can earn that return on capital once that investment is made. And so there needs to be a lot of sort of promises and policies in place for that to take place. And then lastly, there's really two things that can really maintain that return on capital that these companies need. Either the price of oil goes up from where it is today, or they get a lot of high level of concessions, tax breaks, and whatnot from the governments of Venezuela, for example, the government of Venezuela, and then by extension, the US. So that is certainly possible, but that means that that's taking profitability or participation away from the local population. So there's a balancing act there. All of that is to say, There will be supply. We know it's going to come on. It's just not going to be overnight. It's going to take a long time. In the immediate impact, the immediate result is actually a reduction of the supply because of the disruption that's taken place. The production has been halted. They need imports of light crude oil to actually mix in with the thick crude that they have there in order for it to actually be usable, transportable, and movable. And so a lot of that is actually causing a lot of confusion. And so supply is constrained there right now. Okay. So we think that the supply will eventually be there, but by the time it comes online and is there, which could take years and hundreds of billions of dollars, the companies need to make sure that the capital return is there in terms of the price or the concessions. And then B, in our view, given the continually gradual growth rate of the demand of energy globally, then it might be meeting the demand of that future whenever that occurs.
Okay, thank you for that. That's very, very interesting. You were also on the record with your statement that energy is the universal currency. And I want to ask, is it a case, do you think, of he who controls the energy dominates, or is it simply about low gas prices for Americans? And do you think Trump sees this as a strategic move for the USA?
I think it's a bit of both. So when you factor in the type of oil that's coming in from Venezuela or could begin to come in from Venezuela, it's very similar to the one that's coming in from Canada. So we really don't need Venezuelan oil, okay, but it's an additional option. It's an additional source of oil that could be a potential replacement for Canada if we decide to pivot away from Canada and they go towards China, for example. What's interesting is currently the oil that is being produced out of Venezuela, as small as it is, as little as it is going to China. Mm. And if we take that, and it is, a strategic move to control the Western Hemisphere, a return of the Monroe Doctrine, which is, you could say, is the Trump doctrine. So there's definitely some geopolitical rationale behind this to make sure that the Western Hemisphere is dominated by the U.S. So, as I remember I mentioned to you, Mark, in Zurich, my old joke that we better get our bell bottoms out. We're going back to the 70s. Mm. It's not just about inflation. It's not just about oil, perhaps, but it's also maybe about activism and involvement in Latin America. That certainly seems to be coming back into play as well. So that's definitely the case. The other piece is with the potential of more supply of oil at, let's say, attractive prices, that helps the price at the pump. And the price at the pump helps with elections and just making sure that the midterms work. And then also with this type of activity in places like Latin America, which also has, by extension, sends a message to Cuba, that also helps garner and maintain and manage the Cuban vote in the midterms as well. Mm-hmm. So there's definitely some geopolitical strategic moves, and then there's definitely some political moves to make sure that the price of energy remains low for Americans, which will indirectly help with the upcoming midterms and then future elections as well. Our view is that what has happened is this is bullish from a sentiment standpoint. What has happened is it's reinvigorated this sector within the psychology of the investor that hasn't been there in a long time. Okay. So this was, as you remember, my pet phrase is, this energy sector has been long unloved, overlooked, and underinvested in. And that is beginning to change. And that is what we saw when we came up with our thesis of return to tangibles several years ago, saying that the world will gradually come back to tangibles in one way or the other, either voluntarily or kicking and screaming, dragging their heels because they have to. Mm. And that is certainly playing out when it comes to this type of a situation as well.
Okay, excellent. Well, thank you very much. I know from speaking to different fund managers, one particular, Rick Rule, who is very bullish energy and oil, saying that looking at the current WTI price, it effectively means that it's unsustainable for a lot of current producers. So either it changes or no one can drive their cars And I'm just getting a sense from you, if I can sum it up, that short term, you're still bullish oil, so bullish the WTI price. Longer term, it perhaps remains to be seen, but probably more supply, and that just might time very well with the next US election.
Yeah, I think just to be clear, I think in the immediate term, which is happening right now, and that's why you saw the price of oil actually jump yesterday and even today, despite some folks coming out and saying this is going to be bearish for oil immediately, you saw the price jump, which was because there's been an immediate disruption. So that's happening right now in real time. In the near term, there could be a pullback in oil, but it might not necessarily be tied to this event. It might actually be an extension of a fear of an economic slowdown, fear of an economic recession in the US or globally, which is what some of the data has been mixed and pointing towards. So we think that there might be some pullback in energy in the near term, although surprisingly, despite all of that news and all of the concerns about oversupply and all that stuff, the price is still stubbornly in the high 50s for WTI, in the 60s or close to the 60s. So there could be some a downward pressure in the near term because of these reasons. If that occurs, we think that that's a buying opportunity, because in the longer term, once you look past that time period, we think that energy prices are bound to rise simply because of the fundamentals of underinvestment and the continually growing demand, which is small on a percentage basis year over year, but it's compounding. And the folks who are doing the estimates aren't realizing that, because the narrative is continuing to be oversupply, oversupply, oversupply. And what we're saying is, on the longer term basis, once you get past any kind of weakness or concerns about an economic recession, in the aftermath of that, we think that the prices are going to rise because the demand is going to be much stronger than the world realizes.
Okay. Well, thank you very much for your time today. That's Wasif Latif, the co-founder, president, and chief investment officer at Sarmaya Partners.